Good morning, everyone who has jumped onto our webinar. My name is PJ Patterson, and I'd like to welcome you to this month's webinar, which is going to be on depreciation. I thought it was probably timely to get this topic happening again because we are nearing end of financial year, and depreciation schedules and stuff for property investors and business owners is always I suppose a good topic to refresh. And I'm really pleased to have Tuan Duong from Duo Tax. He's a friend of mine that I've known, I don't know, Tuan for probably 4 or 5 years now, I'd say.
That's
And yeah, and I know you've done some work for me and some of my clients and for the IFBF, so, and presenting for the IFBF. And so I'm really pleased to have you with us today.
Yep, thanks for having us today, PJ. And yes,
no problem.
It's been some time, and obviously I've worked with yourself and also Stephen Dinte, a couple of the other guys that have got to know very well. And I've been an advisor and I guess assisting with the IFBF on all depreciation over the years. So really pleased to be here today.
Awesome, thank you. I'm a little croaky today. Unfortunately I've managed to probably catch a little bit of a cold or something from one of my kids. So hopefully I won't cough into the microphone or anything like that as we go along. But if you hear me drop out or don't hear me talk for a moment or two, that's probably me having a coughing fit. But we'll get straight into it. Before we get on to some Q&A with Tuan, let me just mention to everyone that's in the chat room and so forth, you can put questions in. I do have everyone on mute except for myself and Tuan. And if you do want to ask any specific questions, just please drop those in the chat, and I'll be sure at question time towards the end of the prezzo to do that. Just before I launch into it, I wanted just to revise or re-mention to everyone that my business, Keystone Financial, is a business for good. I'm aligned and part of a global social enterprise called B1G1, and we seek to or have aligned ourselves to the United Nations 17 Sustainable Development Goals. All this is to say that my business now as a social enterprise, I really want to make an impact on the world and do that through giving, and B1G1 is the platform I've chosen. And just a few projects that we support: clean water access, building some schools in Cambodia, or helping to do that, and sewing training for women in Bangladesh. I just did my giving for this past month, and I'm supporting now 22 projects across the B1G1 platform, which has now, I think, over 800 different projects. So if any of you business owners that are in this webinar are interested in B1G1, I'm happy to have a chat about that. There's a little snapshot of the 17 Sustainable Development Goals, some pretty cool stuff in there. And for joining us today on this webinar, I'm going to be giving 7,500 days of clean water access to, I believe that project is for families in Ethiopia. So thank you all for joining us. Just before we jump into it, general advice warning: obviously the things we're going to discuss today may or may not apply to you and or your clients. So my advice would be to have a conversation with Tuan off the webinar, and ask some specific questions about stuff that might relate directly to you or your clients. With that, come on, PowerPoint, work. There we go. This is our guest presenter, Tuan Duong from Duo Tax. They're a quantity surveyor specialist specializing, I should say, in doing depreciation and all things depreciation. Very knowledgeable guy, Tuan. I've had the privilege of having him present a couple of times to an organization I'm involved with, and always insightful, always something new to learn. And interestingly, it sounds like depreciation and tax are constantly changing, which is why it's probably a good thing that Tuan is also an investor himself, so he keeps up to date both from the investment side and obviously from his professional side of helping residential and commercial property owners get more out of depreciation. So the format for today is we're going to do some Q&A. And specifically, we're going to, I think, address property owners initially. But why don't we just start with a very basic question for anyone who isn't sure about depreciation. Tuan, what is it? And sort of just run us through that whole thing first.
All right, sounds good. Thanks. And if anyone can't hear me, please feel free to, can they chat away or type away there?
They can. Now, I'll just see if I can get chat open. Now, you may not be able to see it, but let me just see if I can actually get the chat open. But if you go ahead and just chat away, and I'll just see if I can get this to show up for the whole group. If not, I'll just...
Sounds good. All right, so depreciation, as we all know, is the decline in value of a specific asset. In the specific field that we work in, or I myself work in, is in the depreciation of plant and equipment and building assets for the purpose of investments, property investment, whether it be residential or commercial, and we also do conduct it Australia-wide. So given that it is under the Income Tax Assessment Act of 1997, which is a federal legislation tax act, any depreciation advice that I give is applicable across the country. Now, depreciation being the decline in value is obviously the name of the game. It helps us, I guess, assess a value of the value of the asset itself and work out what we can claim over the rest of the building life or the effective life of a specific asset, whether it's the building itself or the plant and equipment such as microwaves, fridges, and cooktops and hot water systems within a building. So that's predominantly what we do, and that's predominantly what depreciation is about. I hope that wraps that one up.
Okay, cool. Well, I mean, obviously that now leads into, I guess, the next question, which how can this actually help a property owner? What is the thing about depreciation that, you know, everybody, especially the people who are involved in investment property purchasing, a lot of the calculations that they might do will factor in depreciation as part of their tax calculations. So how does it help property owner?
Certainly. So the main gist of it is that property depreciation is applicable, given that the federal legislation does allow property investors to negative gear their property. Obviously, negative gearing captures those losses incurred in a building, which might include, as you know, PJ, your interest on your loans is considered one means of loss on a property. The other being council rates, another being water rates, property management fees, and the third one we have, the final one we have is depreciation, which is an on-paper loss. So depreciation on the building obviously is a natural wear and tear of the property, the building itself, not the land, just the building and any plant and equipment assets. So how does it generally help? By a quantity surveyor working out the depreciation rates on these different types of assets on the property, and then working out a schedule that will then enable them to capture the depreciation for each financial year as it's calculated for that financial year, and help the property owner claim a tax deduction specifically on depreciation on their tax return for each individual property. Okay, whether it's business or also individually owned properties.
Now you mentioned in that negative gearing, and I'm assuming that if you did not have a negative geared property, but you had a lot of depreciation, you would obviously still claim that back, and it might help lower your, lower the income, I guess, that you would be claiming in your tax return. So it isn't necessarily just for people who are looking to negative gear. If you had a positive geared property, but brand new, then you had a lot of depreciation, that would effectively help lower.
That's right. Yes, that's right. So I think I should correct myself there. And what we're looking for is claiming a loss on the property, whether it's negative geared or positively geared property. But what we're trying to achieve out of that is claiming a loss to provide some extra cash flow by reducing the taxable income with a deduction that is available by us assessing, a quantity surveyor assessing the depreciation. So any depreciation that the quantity surveyor assesses becomes a tax deduction to the owner, whether it's a business or an individual. Correct.
Okay. Well, that's good. Now, I thought I might just ask there, what is the difference, I suppose, between a quantity surveyor and maybe just an accountant or someone who might.
Or a property valuer.
Yeah, or a property value. Yeah, exactly. What's so special, mate, about a QS?
Certainly so. I think that's a really good question. And quantity surveyor is not a very common sort of profession amongst, I think, the property industry, or should I say, the real estate industry. And so our job is very minor or minimal in the property space compared to in the construction space. So quantity surveyors are regarded as the independent assessors of construction costs. We're advisors and consultants to provide advice to mainly third-party independent bodies such as the ATO in this case, where the ATO allows property investors to claim tax deductions or tax deductions through depreciation. However, the condition is that they need to speak to a suitably qualified persons, such as a quantity surveyor. So in other circumstances, quantity surveyors assess construction costs to councils to assess Section 94 tax. So Section 94 being a council contribution for new developments in order to work out the cost of the development and work out the tax based on that cost of development. The council will always ask for an independent cost assessment from a quantity surveyor that will work out exactly what the cost of that development may be, including, one is the purchase price of the land, which is very easy to determine, but then to determine what it will cost to assess what it would cost to build a new build will be required by us assessing floor plans, engineering plans. It may be structural plans that are available, and in turn, what the council will do then is provide a 1% to 2% tax on the total construction cost of that new development. In other parties, I think yourself might be familiar with, PJ, is obviously the initial reports, bank reports, when it comes to new construction loans, where we've got larger developments that are a little bit more technical. Where, say, for example, if you've got 20, 30 units in a development, in order for the bank to lend on that amount, they will need an independent verification of the construction cost. And that's where the quantity surveyor is engaged independently to assess the cost of construction and ultimately provide the bank with some reassurance that they are correctly lending an amount that is suitable for that construction, and then also the progress reports and progress claims that are paid to the builder or the developer from month to month, and where the quantity surveyor will be required to go on site to assess the completion of each trade, whether it's plastering, concreting works, etc., and to work that out from a month to month and cost to complete, and to ensure that the bank is being looked after and ensure that the builder is doing the right thing by the bank.
Okay. I have seen some of those quantity surveys provided in development deals that I've done, which is really cool. I mean, that's obviously a whole nother level for property owners, and it's good to get that clarification around that side of things, because it probably explains where, if someone gets a brand new property, for example, is going to buy an off the plan property or something, there's often a quantity survey or some sort of schedule that's in the contract. And I'm assuming that might be related to what you just described with the QS providing it to the builder. But for the layperson out there that's just a property, you're sort of stock standard property owner, you've kind of elaborated on what a depreciation schedule is, but what is it really for that person that might just be buying or already have an investment property? What does that depreciation schedule look like? What's in it? What sort of things would you expect to see in there?
Yeah, fair question. And from an investor's perspective, to understand the depreciation schedule, we need to understand what it is that the ATO permits us to depreciate on a rental property. Now, if we've got a rental property that just a general rental property that might be a single-story 3-bedroom property. Now, the part of that building is, we should say that, when we're purchasing a property, the land valuation or the land acquisition cost does not form part of the depreciation, and for obvious reasons. Land is generally an appreciating asset, in the eyes of the ATO. So the only depreciable asset within that the ATO allows us to claim is the building itself and anything that will generally wear and tear. Okay, any loss to the property through the land valuation is generally capitalized in as part of the valuation, and that will either be a capital loss or a capital gain. So that's something that then we'll need to speak to an accountant about. Okay. And that assessment of land valuation will come from a property valuer at the time, and if there isn't a property, a sale price or a purchase price that's acquired at that time. If it's, for example, a transfer in ownership between families, I guess a property value is handy in that case. In the case of preparing a depreciation schedule, if we are strictly assessing the depreciation of a building and its plant and equipment assets, we are asking a quantity surveyor of that building only and those assets. So a depreciation schedule will allow you to claim depreciation, obviously, on those assets. Now, the ATO has got two classes of assets, one being that one is called the Division 43, which is building allowance, capital works deductions. Now, that is at a rate of 2.5% and is claimable on all anything to do with the building itself. So that will be formed by the slab, the framework of the property, including whether it's double brickwork or it might be a brick veneer property, and also any roofing, plastering, joinery work that forms part of that property, including bathrooms and your kitchen fit out. So that forms your Division 43 capital works deduction. Secondly, from that, we have the plant and equipment. Now, the plant and equipment list, it varies. We've got things from carpets that the ATO will allow you to claim, furniture, or, you've got your bedding. It might be, any lighting features within the property. They're all depreciable. Now, with these assets that are motorized, like your hot water systems, your microwaves and whatnot, these assets here are depreciable, but at various rates. Obviously, items and these rates of these effective rates depend on the effective life of of those assets itself. For example, you may have carpet. Carpet is generally going to wear and tear much slower than any motorized equipment. And so what you'll find is any equipment such as carpet will have a higher effective life and hence a slower depreciation rate. Okay, the depreciation rate will be lower compared to your fridges and your hot water systems. So what you'll find in the depreciation schedule is 40 years worth of depreciation on as an example, a 40-year property. So you've got a 40-year property, a brand new property. The depreciation on that will be over 40 years, which is your 2.5%. So you'll get 2.5% depreciation on a building. And if it's, say, for example, $100,000 on the building itself, that's $2,500 deduction per year, okay? On top of that, you also are allowed to claim also the Division 40 assets, being the plant and equipment, and that might be $50 on a microwave this year, $100 on the hot water system this year, so on and so forth. So your total depreciation on that schedule will show perhaps $3,000 or $4,000 in the first financial year, but it will go on as a schedule. It will be for the life of the property. So it's also retrospective as well. Not only is it a forecast report where it shows you the depreciation over the life of the property, which means that it's pretty good value. What you're getting is a schedule to claim depreciation over the life of the property. So it's only obtained once through a quantity surveyor to give you a forecast depreciation figures for the balance of the life of the property. And that forms a depreciation schedule. And there are a couple of different methods of depreciation as well, being that diminishing value method, which is an aggressive method of depreciation that the ATO permits you to claim, and also a prime cost method, which is pretty much a straight line method of depreciation, where you're getting 2.5% or 5% on certain assets for the whole life of the property. So there are various methods of claiming, and that the ATO does allow a quantity surveyor to portray to the investors, and it gives them the options to claim. However, they are required to use the same method of depreciation for the balance of the life of the property once they've chosen that method.
So if they start on diminishing value, you've got to stick with diminishing value.
That's correct.
Yeah. Okay. Now I've heard some terms like low value pool and stuff like that. And I'm assuming sort of what you described there, that Division 40 plant and equipment, that's probably your low value pool, because you accelerate those items that they get used up quicker, I guess. And that's what you see on the depreciation schedule versus the Division 43, which extends out over a longer period of time. Is that understanding pretty right?
Certainly, I can answer that one. And the diminishing value is where we apply diminishing value method to the plant and equipment is applied, but however, we don't apply diminishing value method to the building. So the building is at a fixed rate of 2.5%. However, you're right that the plant and equipment can depreciate at an aggressive rate using low value pooling and also the write-off method. So if an asset is purchased in the first year and it's worth less than $300, for example, you've got a table lamp. Now, a table lamp might be purchased for $250. The ATO will apply some common sense with that, and rather than depreciate a low value asset like a lamp over 10, 15 years, they will allow you to depreciate that asset immediately in the first year and write that off as a $250 write-off on the tax deduction in the first financial year you purchase it. On any other asset that's worth less than $1,000, it's also accelerated at 37 or 18%, depending on the year it was purchased.
Mm-hmm.
And also, if it doesn't fall below the 300 or 1,000, it's valued over $1,000. It will fall under the effective life depreciation method, which is a formula really using the years of depreciation that's allowed, the cost of the asset, and a specific formula that will allow you to depreciate at that effective life depreciation formula. So anything over 1,000 uses the formula. Anything less than 1,000 will be either 18% or 37.5%. And if it's less than 300, it's 100% depreciation.
Okay. It's, I prematurely clicked on the next question, but I think what's interesting at the moment is a great chance to pause here and ask this question: why is it so important to have a depreciation schedule? And clearly, with all of this stuff that you're explaining, there's a lot of numbers you're throwing around, a lot of different percentages. It sounds like there's special divisions in the tax code that apply. And so the message that I'm hearing loud and clear, first of all, is that it's super important to have a depreciation schedule, because and I'll let you elaborate on this, but it sounds like there's so much involved in, claiming some tax benefit that if you didn't have one, maybe you're really missing out. So why don't you just, elaborate on why it's so important to actually get a depreciation schedule and get one properly done?
Yeah, certainly so, PJ. And I guess it's really, being a property investor, to my knowledge, is about utilizing all the correct tools that are available to us. And that might be, assessing for the best interest rate, best, package that you might have. I'm no expert, but I'm always looking for an aggressive or strong interest rate that can help me lower those costs, of those bank fees and interest payments from month to month. And the other tool that we're looking at that I'm very aware of is the tax tool, that is depreciation. Now, this here is a cash flow tool, and ultimately what we're doing is we're trying to boost the cash flow from year to year, especially in the earliest years where a depreciation is the most aggressive. And what they say with depreciation is it's a non-cash deduction. In what that means is that it's a deduction, it's a tax deduction that you physically don't have to pay for. Similarly, if we can compare things like your water rates, council rates, and property management fees, or even your interest on your loan. Now, those are cash deductions where we've got to fork out the money in order to make a claim of tax loss or a loss to our taxes because of that situation. Now, depreciation being a quantity surveyor's report that's been generated to assess the depreciable amount on the building is an on-paper loss. And because it's an on-paper loss, there is no physical amount of money that we have to fork up in order to make a claim for depreciation on our tax return. So that's the benefit of claiming depreciation. So it's ultimately money for nothing. There are some balancing adjustments that have to be made, like as some of us will know that selling a property, there are some CGT applicable to the sale of a property. And that's where, some tax advice will be needed by your accountant or your tax advisor to understand the situation there. But from what I understand, there obviously are some benefits like your 50% CGT discounts that are currently available. I'm not sure what that's going to be like in the future. I've heard different rumors about that, but at the present time, there are some benefits in claiming depreciation, and even at the sale of the property, there is a requirement to pay some of that back. But with a discount, from what I can understand, there are some benefits still, even as a net result, in claiming depreciation for the next 3, 4, 5 years of a property that you own.
Okay, and that's broadly my understanding around depreciation as well. And obviously, you're not, giving any tax advice, but that you do need to make some adjustments on the cost base, considering depreciation that you've claimed down the track. So we'll leave that one to the accountants in the on the webinar to worry about. And you've kind of answered the next question, which was, what can be claimed? I think you've given a pretty thorough explanation of your Division 43 and then your Division 40 things that you can claim. But is there anything else maybe that you'd like to add to what you might have already said, or do you feel like you've covered that pretty well?
That's pretty much covered. There's obviously some adjustments some minor amendments that have been made to the previous legislation as of 9th of May 2017 budget, which was the biggest change was that if you've got a second-hand property that was purchased after that date, meaning you've exchanged contract, you can no longer claim second-hand plant and equipment if you've purchased a second-hand property. However, you need to, if you'd like to claim plant and equipment on properties purchased after that date, you will need to buy the plant and equipment yourself. So it's got to be from a retailer of sorts in order for you to claim depreciation on those plant and equipment assets. Second-hand buildings are fine. That's not affected by the legislation in May 17. However, plant and equipment has been affected. And if you previously purchased a property prior to 9th of May 17, you're exempt from this new legislation. It's business as usual, and you are grandfathered from that new legislation.
Okay, well, that's a pretty interesting development. I think I remember you talking about that, and that leads into, I guess, this next question, which you've kind of just started to address, which is, does the age of the property matter? And so let me just give you a scenario. So I buy say a 10-year-old property, still reasonably new. It's I'm guessing, and let's say I did not get a quantity survey handed to me by the seller of that property. Maybe they had bought it and owned it as an owner occupier. So no survey had ever been done, no depreciation schedule ever been done. Walk me through that scenario and maybe just elaborate for me on, first of all, does age of the property matter? And then secondly, how would you tackle a situation like that? How would you advise, say, I bought that property as an investor? How would you advise me to deal with that?
Sure. And so you bought this property 10 years ago, or it was?
No. So it's a 10-year-old property that I've just bought as an investment. Sounds
good. So you've purchased a property 10 years old, so that lands us in about approximately 2009. Now the ATO legislation, the ATO does allow Division 43 to be claimed, which is your building depreciation on the capital works. That is cut off on the 17th of September 1987. So any residential property that's built after that date, that means occupation certificate is after the 17th of September 1987, will qualify for building depreciation. So that means automatically you qualify for building depreciation. So what a quantity surveyor will do is work out the construction cost of that property that was built in 2009. We've got various indexes and whatnot to work out the construction cost of say a 3-bedroom house that you've bought in Brisbane, might be metro area. We'll have a rate of depreciation to apply for a brick veneer home in Brisbane in 2009. That will then give us a total construction cost of say 180,000. We'll then apply 2.5% depreciation per year to that property, regardless of what the purchase price is. As we understand, as just going back there, that the land valuation has no bearing on the construction cost of the property. On top of that, we'll then assess whether it qualifies for plant and equipment, which is Division 40, which I've mentioned earlier. Now, that requires a property to be brand new in order to claim depreciation on plant and equipment. But given you've exchanged contract after the 9th of May 2017, you are disqualified from plant and equipment depreciation unless you purchase the equipment yourself. And so you will get a schedule for 2.5% of $180,000 that will last you from 2009 through to 2038, which is 40 years of depreciation. Sorry, 2048, which is 40 years of depreciation on that residential investment property. Okay.
And if the so just on that, if someone had owned it originally as an owner-occupier, am I able to claim the first 10 years on that depreciation schedule for the capital works in one hit? Or is there some recognition? This might be tax advice, so I don't know if you may not be able to answer this, but are you able to then just do it from the 10-year mark forward?
Yep. So it is a retrospective report, and say, for example, if the report, regardless of when it is generated, can be dated from the date of settlement. That'll be the effective date of when the property is first available for rent, which is the ATO's definition for when depreciation can be claimed. So if it's a brand new property, we work it from the occupation certificate date. If it's a secondhand property, we work it from the settlement date that the property is in your ownership and you're entitled to make it available for rent or have it rented out. Okay.
Good to know. And that's a great segue into this next question, which is kind of what I'm exploring right now, which is I've never had a depreciation schedule. Is it too late? So maybe we'll throw up a different scenario here, which is maybe I bought a property, let's say it was brand new.
Yep.
I didn't have a quantity survey that was given to me, and no one has ever asked me for one. And maybe it's 4 or 5 years down the track, and I go, somebody a very smart mortgage broker like myself comes along and says, "Oh, where's your quantity survey?" And the person says, "I don't have one." Is it worth getting one done at that point? And then what would that scenario look like for me as an investor who had never done one but had maybe owned that property from day one, brand new?
And this was an owner occupied this property?
It was purchased for investment straight away. So let's say I just bought an investment property straight up, and but did not get a quantity survey done. So I'll give you some metrics around this to make the example a little bit easier. Let's say I bought a property 5 years ago, brand new,
yep.
And but I never had a QS, and I have not been making any claims in my tax return.
Yep.
Let's just say I didn't have a very good accountant.
Yes.
and he missed it. He or she missed it. And so, is it too late? What should I do? Well,
firstly, it's probably I've had it's a very common occurrence that clients come to me with they've either switched accountants and said that I've never been told to get a depreciation schedule on my brand new apartment, which is crazy, but it does occur. And my answer is that you've got a 5-year-old property that you bought brand new. The depreciation on that would have occurred over the last 5 years. You are entitled to claim that depreciation from the very start. Now, I should stress to you that my understanding as an individual taxpayer is that when we are amending individual tax returns, we are entitled to amend the last 2 tax returns based from 2 years from the notice of assessment date.
Mm-hmm.
So if I do my tax return in July 2017 for the 17 financial year, I have until July 2019 to amend that tax return. Okay. If I am a business, I am allowed the same. However, it is 4 years. So if it's a business-owned entity or property, we're allowed to amend 4 years worth of tax returns to make claims of depreciation loss to that property. And however, I have had clients in my experience that go back 10 years to claim depreciation. However, it's not a guarantee that we can claim depreciation on a property that's been owned for 10 years. The only way to do that is that we can raise an objection, which is a form that's on the ATO website that will let you give reasons as to why you would like to amend a tax return beyond 2 or 4 years, and what on what, and they will grant that on a case-to-case basis. So so it is possible, but to be sure that you are claiming depreciation, I would always suggest 2 years worth of amendments, and claim depreciation from there. And in the case that it is a brand new apartment or house, we can claim depreciation on both ends, both the plant and equipment and the building, and we can claim that in the last 2 years or 4 years, depending on the entity that's purchased it. But we can go further back and claim 5 years. However, it's on a case-by-case basis, depending on how the ATO feels. And that can be supported with a tax depreciation schedule to make that happen. So we've had that on various cases. In all cases, the client has been successful, but there is no guarantee, and that's really the gist of trying to claim more than that.
Okay. So the moral of the story is, I guess it's probably never too late from what you're saying, but after a certain time frame, the ATO has the ultimate discretion as to whether to recognize an amended tax return beyond a 2-year window, as to whether they're feeling in a good mood that they want to give you some coin back.
Exactly.
So that probably depends on whether the government's running a deficit or a surplus.
That could be so. That could be so, PJ.
Okay, good. That's fantastic news, and it hopefully anyone that might be listening to this into the future who did not get a depreciation schedule done know that it's not too late, and it's probably worth the money to invest in that. I have had a question come through from David Nord, good mate of mine, Nordy, who's asked about the cost to prepare a schedule. We'll come to that, David, just towards the end of the webinar. I will ask Tuan to just elaborate on some of their fees, but we'll just kick on. We're getting close to the end. I'll just kick on. I think we already answered this question, actually. Can an accountant prepare a depreciation schedule? Can they actually prepare one, or do they need to have a specialist do that?
They surely can. An accountant will always be able to prepare a depreciation schedule when they're given the exact costs based on a receipt or a tax invoice or some sort of document that will suggest the total cost of that asset. The reason why the accountants will refer a quantity surveyor, and what's majority of our referrals do come from accountants or tax agents, is the reason being that either properties are secondhand, where they've purchased the property, and that will obviously encapsulate the cost of the land acquisition as well as the building. And our job is then to segregate what is the building component, and then on top of that, what is the plant and equipment component, including each asset, whether it's carpets, blinds, lighting, etc. On brand new properties, accountants may refer us because on a contract of sale, most contracts, as we probably know, they're fixed price contracts. And so it may be a lump sum of $350,000 to build a 4-bedroom home out in Austral. And given that, a $400,000 depreciated at 2.5% is not going to be, that's something that some accountants do, but it is probably not the best way to do it, because 2.5% is not going to give us a better depreciation per year compared to us, the quantity surveyor, assessing each plant and equipment and then getting aggressive depreciation on, say, hot water systems, carpets, blinds and whatnot. And that, instead of getting, say, for example, I think it's $12,000 on a $400,000 home, if it's 2.5% building cost. If we can get, say, for example, some plant and equipment there, we usually are able to stretch it to $16,000 to $20,000 on a $400,000 per construction cost.
Okay. So the difference really is, I guess, that you as a quantity surveyor are empowered to go in and apply a different metric to everything than an accountant can. They just, what you're saying, they just take information they're given and they prepare a schedule. You go in and actually utilize different tools to actually prepare a very detailed schedule.
Yeah, so that's where we go back to the ATO, the TR 2517 is, sorry, TR 2597 is ATO does allow in that ruling suitably qualified persons such as a quantity surveyor to make assessments on plant and equipment assets and building assets if there is no cost given. And that's something an accountant cannot do. unless they have some sort of written evidence of the cost of that asset. So your basic printer being purchased by a retailer would be quite easy to depreciate. On the other hand, a property that's built a property that's built with with a lump sum will need some sort of breakdown to work out each asset's value in order to provide a better return for the investor on each financial year, rather than claiming 2.5% on the lump sum of the construction costs, if that makes sense.
Yeah, good. Fantastic. So I think the what I'm hearing is it's probably worth getting a quantity surveyor to get in there and actually get that level of detail added to the schedule. You might save some serious dough.
Yes. Yep.
Cool. I think we might have answered this question already, but if you've held property for a long time and haven't claimed any depreciation at any point in claiming it now, I think we covered that in the example that I gave. Do you feel like we've adequately answered that question? Is there anything you can add to that?
I think we've answered that one quite well, PJ. And just wanted to mention there that it's because of the legislation and to be honest, from time to time, it jogs my memory too in understanding the various legislations that have come into play in the last couple of years. And so the best way to understand that is always, because there are so many different, controls that the ATO have regarding brand new, existing, when it was built, et cetera. What I always ask is provision of an address for the rental property. I will then assess the settlement date, the build date, and the type of property and also the entity that owns the property, because as we know, the second-hand claiming of plant and equipment is only abolished for residential property investors, individual residential property investors. Commercial property investors aren't affected, and business entities that own property are also not affected by the legislation. So I always suggest worth shooting us a investment property address. We obviously have access to RP data, and that helps us identify whether it's worth claiming or not. And we give estimated tax deductions or depreciation, just to make sure that the client is at the end of the process. We're adding value to that process.
Okay, well, that's a great segue into our next little section here, which is on business owners. And you just touched on a key distinction there, which is that commercial property owners were not hit by the same legislation change as residential property owners. But I think there's an added nuance here, which is someone that might go in and rent a commercial property, so for business, and they put maybe some plant and equipment and so forth in there and some fit out. They have possibly a need for a depreciation schedule as well. So let's just broadly put that under the umbrella of, can a depreciation schedule be useful to a business, and in what way is it useful to them?
Yeah, I should add to that one as well. The individuals who buy commercial properties are also exempt from that old legislation, the new legislation. So if you're an individual taxpayer and you've purchased a commercial property, you can claim all the plant and equipment on that property as well. Okay, so that's one benefit of investing in commercial. If you are looking to go down that avenue. On your next question is that can a depreciation schedule be useful to a business? The biggest advantage is that the businesses that buy property are exempt from that ruling. So you have the advantage of claiming all plant and equipment on a property, whether it's old or new. And the biggest, for example, if a property, when I say second-hand property, the ATO will still let you claim depreciation on, say, an old garage door that has changed hands perhaps 4 or 5 times in the last 30, 40 years. They will still allow a quantity surveyor to assess the second-hand value of that garage motor as it is worth today, and allow the business owner to claim that as a tax deduction on that asset.
Okay.
So that's a big benefit, and also owning a building in itself, you are entitled to claim the building, but like any residential property owner, but also the fit out. So if you've purchased a business and there's an existing fit out within that business premises, that within that building, you are then allowed to claim depreciation on that existing fit out. So yeah, that's probably the next question.
We're kind of into that. Yeah, that's why I put it up.
Yeah, what can a small business claim? And so you're entitled to claim the existing fit out that you've purchased part of that that property. And if that fit out is not to your liking, and you decide to scrap the existing fit out, you're entitled to get a quantity surveyor to assess the value of that existing fit out that you will scrap, and we will actually claim a scrap value to that as a tax deduction. So we've had clients here have bought $3-4 million type properties, or even $500,000 offices. They bought a little office in Norwest Business Park in here in New South Wales, and they've decided to scrap the existing fit out, glazing, carpet, all the joinery throughout, all the it might be the kitchen and bathrooms that have also scrapped. We've gone in there and scrapped for them $85,000 worth of the residual value of that fit out. That becomes a tax deduction in that financial year for that property investor or that business owner.
Wow.
And they are then allowed to claim depreciation on the new fit out that is installed or fitted out to that premises. Whether they're the business owner or they may be the landlord, or whether it can be on the other side of the spectrum as well. If you're renting the property and that you're obviously putting in a new fit out, you're entitled to claim that fit out as well as a depreciable item on your tax return.
Wow. And so this leads me into a question, which is broadly with your business, what percentage of your business would you be doing just the standard sort of QS for residential property owners and such like versus business and commercial property owners?
Yeah, so it's we're finding that especially because we've got a big Sydney base, which is where our head office is based. Our investors are sort of swaying mainly interstate, so we're getting less properties that are purchased locally here in Sydney or New South Wales. We're having more people sort of venture out to interstate, but I would say almost 10% of our clients are now of our business is actually coming from commercial property depreciation, because it is. I think there's a lot more drive in the market for commercial, and it is a very stable industry. In from what I understand, and I do a bit of it myself, and I have I see some huge advantages in investing in commercial, and it is very popular amongst the client.
Okay. But it sounds like if only 10% of your business right now is dealing with that side of it, it almost sounds like there's an opportunity there, particularly for any finance brokers that might be listening to this, to engage with your business clients who either own commercial property or maybe have a business, even if they're just renting space, and ask them if they have thought about getting a depreciation schedule done on their commercial premises and or the fit outs and things like that inside of the business. Could very well be some savings there from the sounds of it.
Certainly there is. I think there are huge benefits with claim depreciation as a business owner. And it's very common these days to have businesses that are setting up this SMSF to buy the building, the property itself, and then having their business claim the scrap. Their companies claim the scrap value of the existing fit out and also the depreciation on the new fit out. That's something that's we find very common in today's market, where SMSF seems to be very popular. And being able to claim depreciation on both ends is very beneficial.
Yeah. Oh, I like the sound of claiming it on both ends. Stick it to the ATO wherever you can.
That's right.
So we've kind of answered that question about, if you're a tenant, is it useful and what can be claimed? Is there anything else you want to just add to that?
Yeah, so the existing fit out, it's certainly it's a huge advantage that we can claim depreciation on the fit out, but also then scrapping that gives us a really big advantage, is that because the fit out can be valued as well, whether it's your fit out or not. Once you scrap that and you're entitled to claim the scrap value, that can have a huge impact on your taxable income or taxable, your losses for that tax year. especially when you're investing, $500,000 or $1 million on a new purchase, and you decide you take into consideration that fit out cost, that existing fit out cost that you don't want. That can have some bearing on the financing, and I guess on that end of the spectrum, whether it's feasible or not to purchase a property, and so to know that will give a peace of mind as to whether perhaps whether it's worthwhile investing into that type of property.
Okay.
Yeah.
And I suppose, do you need to do the survey prior to tearing out the existing fit out? Obviously, you would.
Typically, that would be the most, I guess, the most effective way of claiming as much as we can. In the cases where we don't have the actual, aren't physically able to measure, we are able to work off floor plans. So there's a floor plan in place and great evidence of photos, as per perhaps on the sales, any sales photos that were provided, or photos prior to the fit out and photos post fit out. That might be able to help us identify the type of fit out and the cost of that fit out itself, and we'll make I guess our estimates may have to be a little bit more conservative. However, as long as we have enough evidence of pre-fit out, post-fit out, that will be able to give us a good indication, along with floor plans or strata plans, to work out what can be scrapped, or if there's any fit out that can be to be scrapped over the next year or so. For sure.
Well, there you go. If you don't have any physical documentation, use the photos. You'd be a bit of forensic QS.
That's right. And probably worth noting on that too, in these circumstances, usually it's a scrap or a fit out that's been demolished in the last year or two. Mm-hmm. If that's the case, that's the benefit of using or I guess amending your tax return. The 2 or 4 year rule that we were talking about, that certainly will come in handy if we're deciding to scrap something that we are claiming a scrap something from 2 or 3 years ago. We can always do an amendment to the tax return.
Okay.
Yeah.
Perfect. Well, we are getting towards the end of our time together, so let's just quickly delve into your firm. And we've been talking a lot about what you can do for a property business owner. But if you just want to elaborate for me on that a bit more, just maybe address these two items. What typically does a report cost, and how does your service work? Just tell us a little bit about how you do that.
Yep, sure thing. So with Tax Quantity Surveyors, we're a small firm here based in Sydney. Our firm does extend our services Australia-wide, and originally the business was always sort of Sydney-based, looking after Sydney properties, but because of the need of our clients that are buying interstate, not only residential but also commercial, we've contracted a vast number of property valuers and quantity surveyors interstate that contract to Duotax to assist us, on a national scale, to work out depreciation on all type of assets. These type of assets include, we've got clientele that buy properties that there might be fuel stations, all types of sheds, warehouses, industrial sites. Nothing that we don't really do. And there's really no scope. We've done shopping centres in Sydney, large-scale shopping centres. So that's it does vary. But being that 80 to 90% of our work is in residential property, that really is our expertise, and we do help property investors all over Australia to maximise tax deductions on their rental properties. Typically, what we charge here for a report is $699, including GST. And just being forward with you, we've got a special agreement with IFBF, as I've been a member there since I ever started this business 4 years ago. We've got a fixed fee of $550, including GST, for any residential property across Australia. Doesn't matter where it is, it's all fixed fee. The only additional fees that we do charge are if their clients have, if it's a multi-unit residential, whether they might have a house and a couple of granny flats on the back, or a granny flat on the back, we do have a surcharge of $330. But anything that's commercial, that does start from $770, and that might cover, your small, your small store, or you've got a little office, a small office. That will start from 770, and that can vary up to thousands depending on the type of, industrial site or whatever site that it might be, commercial, or even, we've got our fuel stations that we do, service stations that cost a considerably amount more because of the amount of latent equipment that we have to assess as part of that report.
So I guess this probably goes without saying, but a quantity survey would be tax deductible to the business or to the individual, wouldn't it?
That's correct. In the given year that's invoiced and paid, that invoice is 100% tax deductible, including all. Yep.
And typically, do you find that you are able to save the client the amount of money that was spent on the QS? Is that a typical result for you?
That would be the ideal result, and I'll have to be frank, but with the change in legislation, there have been clients that have been turned down from depreciation. Obviously, one, because their property is built well before 1987, and two, because their property is that the property is purchased after the 9th of May, so they're disqualified from both, not just the building depreciation, but also the plant equipment being secondhand. So there are a few, especially older properties, and that are affected, and so as such, that has had a result, some sort of bearing on our business. However, it's pushing investors, and as people are aware of the changes in legislation and what they can and can't claim, that will also, I guess, sway their decisions in the type of property they may buy. So as people become more informed about these changes, I think people become, over time, they'll become more well versed with what they can or can't claim. So that's I hope that answers that one.
Yeah, I think so. I mean, it sounds like if there's any doubt, maybe just give your firm a call, and I'll put the contact details up here in just a moment. We only had that one question, what rough cost was for a standard depreciation schedule. If anyone else has any questions, what I'll do is I'll just put up the contact details now for Duo Tax, and you can grab those. You can obviously go to the website, duotax.com.au, or give the firm a call at the 1-300 number there, or shoot them an email as well to
attention it to myself, Tuan. I'm more than happy to take any inquiries. If there's any questions or doubt about the legislation, or if there's a residential property or a commercial property with an address that you might have, flick it through to me, and I'm more than happy to do an assessment, which is obviously at no cost to yourself or the client. Happy to have a look at it, and if there's any value at all, I'll let you know the feasibility of it, too, and then we can try to help the client if that permits.
Perfect. Well, I haven't had any flood of questions. That obviously means we've done such a great job of covering depreciation. I can't believe we've spent an hour talking about a subject that arguably isn't that exciting, but I guess when people know that there might be some money that they're going to get back from the ATO, that they perk up their ears. So I think we shall leave it at that. Tuan, thank you very, very much for joining me today and running us through this lovely topic of depreciation and depreciation schedules.
Well, you're welcome, and thank you for having us here, PJ. I appreciate everyone's patience and time, and any questions at all, please feel free to shoot. And yeah.
No problem. Actually, we've had a quick late question from Nordy. Is it necessary to update a depreciation schedule over the years of owning an investment property?
Yep, that's a great question, David. And we do not need to update a depreciation schedule with a Duo Tax depreciation schedule, because we provide a full 40-year forecast report, meaning that if the ATO allows 40 years of depreciation or 20 years of depreciation, depending on when that property was built, we will provide the full schedule. The only time we need to update a tax depreciation schedule if there's an extensive renovation made to the property, or even if your clients might have updated the property with, say, a new dishwasher. We update the report for free. There is no charge in updating the report with one or two assets. It's only when the property has an extensive renovation, they might have done an extension to the back, or they've fully refurbed the property. That's when we'll need to, there will be another charge for our service, as we will need to go out there to verify that that property has been substantially renovated. I hope that that answers your questions. But updates to depreciation for minor changes is fine, but you will not need to update your depreciation schedule with a due tax schedule if you do not make any changes to the property. I hope that answers your question.
Cool. That's great. And that's a nice little bonus too. If you just have a minor thing that needs to be changed, like, as you say, you buy a new piece of equipment to replace something, that you'll do that for free. So, well done. Well done. Well, we shall leave it at that. So Tuan, again, thank you so much, and enjoy the rest of your day. Really appreciate having you.
Likewise.
Thank you on.